Now, I had mentioned, of course, we just talked a little bit about for Jesus about using the structure of a position, shorter term covered calls to get a higher annualized return, selling week by week, every 2 weeks out or every 3 weeks out in time, rather than trying to sell 6 months out or so forth. There are investors, of course, who do sell leap covered calls or do leap collars. They don't have to look at the position as often, but they know they're getting a lower annualized return by selling month by month or week by week. They're also doing less work, but again, every investor is their own. The spreads we're looking at here are slightly in the money bull call debit spreads. And in the sample searches, we've created one that's out of the money, out in time bull call debit spreads. Now, this is a different approach where an investor might look to sell an out of the money call 60 days, 70 days, 90 days out in time and buy it just a slightly in the money call because they're looking for more of a 1-to-1 risk reward ratio. Here's a debit of 283 on a 5-point spread. It's 147 days out. So the max profit would be 217, just a little bit below a 1-to-1 ratio or 77% return. Here's one on a debit of 45 at midpoint on a dollar spread, stocks at 19.90, selling the 20 and buying the 19. 45-cent debit, so a max of a 55-cent profit on the position, or 122.2%. So this is an approach that's become discussed in the last 3 years, and it's gained a lot of traction of using the at or out of the money bull call debit spreads. We're sort of straddling the stock price, as we talked about with the covered combination, but in a different aspect. Instead of selling an out of the money call and selling an out of the money put, here on the debit spread, we're selling the out of the money call and buying a slightly in the money put, or at the money call, excuse me, for the bull call spread. Instead of looking for a higher probability, lower return, and 5-to-1 or 6-to-1 risk reward ratio, we're going out of the money with the sold call for a lower debit and almost a 1-to-1 risk reward ratio, $72 profit off of a $95 debit here on some very odd strikes on EW. Now, the reason I wanted to bring this up, and yes, Steve, I will look into that for the maximum profit, as I mentioned, but last week, sometime, Ravi had called in and asked me a question about managing a successful bull call debit spread of this type, an out of the money bull call debit spread where he was 60 days out in time or so. And what happened is the stock essentially exceeded his expectations and was above both strike prices well prior to the expiration date. And Ravi, of course, had asked me about what could he do now to manage the position. So I'm going to take a quick interlude here. Please send in other questions as you have them. But I'm going to take a quick interlude here to jump on over to what I was working for with Ravi, and I wanted to put together for everyone, but I just didn't get a chance to do it. I didn't get a chance to finish it today. All right, so rolling a successful bull call debit spread. Outcomes of rolling the individual legs or the whole spread up in price, depending on your outlook for the position. Now, what can be done with a profitable bull call debit spread? And this is the one that's far out in time, remember, at or out of the money, looking to maybe take profit early if you've hit a 50, 60% of the expected max profit. So we start with a far out or out of the money debit spread. The stock exceeds expectations and moves above both strike prices early, so we're looking at a good 45, 50, 55% of the maximum return 20 to 30 days before expiration. Now, to increase profits, if we're still bullish, is it best to just roll up the sold call of that bull call debit spread, roll up the long call only in the bull call debit spread, or move the whole spread up? So let's just take a look at the quick example. On August 17th, Microsoft was trading at 293. A position was entered using the 1st of October, roughly 58 days or 2 months out in time, out of the money bull call debit. No, it's 45 days out in time. With the stock at 293, and bought to open the 290 call at 1085, sold to open the October 300 call at 585. Well, the total net debit is $5. And if the stock's above 300, we get the 10 points back on the debit spread. So the maximum profit is $5 on a $5 investment, or 100%. Now, at the time, on August 17th, with Microsoft at 293, the probability of it being above 300 on October 1st expiration was 38%. But this is one of those almost perfect one-to-one risk-reward ratio, paying $5 for the potential to make $10 or $5 in profit, one-to-one risk-reward ratio, 45, 55 days out in time, straddling the stock price at 293 by buying the 290 and selling the 300. Okay, now, on August 24th, 7 days later, Microsoft moved up, went up to 302.62, above both strike prices. So he's now in the money on both. And this was due to Apple announcing that Microsoft announcing that they're going to increase the yearly cost of their Microsoft Office suite. I'm not happy about that, of course, but it worked for Ravi, and Ravi has a good profit. So as a customer, I'm happy for him. In any case, on August 24th, 7 days after the trade was open, liquidation was close to 50% of the expected max profit. That's usually a trigger in these trades where investors will look to close out of the position if they've gotten the 50 or 55%. They'll also close the position if the stock falls. And the liquidation loss is around 250 or so, or 50% of the maximum 5 points, the at or out of the money debit spread. So what now? Ravi wanted to know what he could do now that he's close to the 50% profit. Should he close the position, just get out of it, take the profit and be happy? But if he expects more upside, what is the best way to get more profit? Should I just buy to close the 300 and roll up to the 305, similar to rolling a covered call? Should I leave the 300, sell to close the 290 call we bought, which is a higher profit, move that up to 295? Or should we close both legs, take the liquidation profit, and now open a whole different spread that's 10 points apart, but at those higher strike prices? This isn't every scenario, but let's break down the 3 examples. Always want to start off with, what do we know? Where are we now? Right now, we're at a position where we could make $500, 38 days away on October 1st if the stock stays above 300. Or we could liquidate now. Liquidation value is $725, so we'd make a profit of $225, or 45% of our $5 debit into the position. Take the profit, move on, look for a new trade. No chance for a loss, but no chance for a higher profit. So we know where we are right now. What would rolling up the short call look like? Just like rolling up a covered call in the same expiration, this would be done at a debit. We looked earlier at the covered combination. We sold a 55 call for Ally and maybe sold the 50 put in the covered combination. The stock goes above 55 early, and I stay in September. I buy to close the 55 and sell, say, the 57.5. It's going to be done at a debit if I stay in the same expiration. Very similar. So rolling just a short call is going to put us into a higher debit. But our upside potential profit's going to increase because we're also going to move the strike difference in the bull call spread from potentially getting 10 points back to now getting 15 points back, even with a higher debit. But the cost increase also means the chance for a higher amount of loss comes in if the stock reverses and goes against our expectations. My action, I buy to close that 1st of October 300 call for $860, and I sell to open the 1st of October 305 call for $590. This is an additional debit of $270. We already accounted for the $5 debit. By buying to close this at $860 and only getting $590 back at the higher strike, we add another $270 into the debit. We could break down the math a different way. Of those transactions, what are my buy actions? We bought to open the 1st of October 290 call on the 17th of August for $1085. And we just bought to close the October 300 on August 24th for $860. So I've put $1945 out of pocket into this position. But we also sold to open the 1st of October 300 at $585 on August 17th, and sold to open the October 305 for $590 on August 24th. So we took $1175 in. So $1945 out, $1175 of premium in. That's our $7.70 debit. Original position was our 1-to-1. Debit of $5 on a 10-point spread if we got assigned on October expiration, bought shares of stock at 290 to sell at 300, we'd get 10 back. We'd make a profit of $5 on an investment of $5, 100% potential return. The new position, we increased the debit up to $7.70 by rolling up the short leg to the 305 strike. We now have a max profit of $7.30 because we're in a 15-point spread, the 305, 290. We haven't touched the long call. Now, we're still close to about the same percentage return here, 95%. If I got filled at better prices, it might be up at 98, still close to 1-to-1 risk-reward ratio. And I did increase the monetary maximum profit that Steve L. just asked about. What is the max profit? I moved it from $5 up to $7.30 by rolling up the short leg. Trade-off, unfortunately, is we also added to the cost. So now instead of potentially losing $500 if Microsoft had a bad week and dropped way down below to 270, 275, now I could potentially lose $770. It's a trade-off. What does rolling up the long leg look like? Well, just like it would look like if I bought the 290 call on Microsoft and the stock moved up higher than I expected, I could sell to close the call and roll up to a higher strike price in that case. And what would this do? This would reduce my risk or my cost. I'd have a lower cost in the position because I profited some of the profit that I earned on that initial long call. But in the debit spread, we are going to reduce the cost and risk, but we're also going to lower the strike difference from 10 points to 5 points. So that means a lower max monetary profit. The action, sell to close the October 290 call for $15.85. This is on August 24th. And buy to open the 1st of October 295 for $12. We get a credit of $3.85. Made a good profit on that long call position, about 5 points that we bought at $10.85. We're going to take some of that profit to move up the strike at a lower price to $12. So we get a credit of $3.85, which completely lowers our cost basis and the debit on that position to only $115. Okay, great. So again, math works both ways. We could look at it this way. What were our buy actions? Originally, bought the October 290 call on the 17th for $10.85, and we just bought the October 295 for $12. I've paid $22.85 out of this position. Now, my sell actions. We originally sold to open the October 300 for $5.85 on the 17th. And I sold to close that initial 290 at $15.85. So I've taken in $21.70, $22.85 out of pocket, $21.70 in, new net debit of $1.15. Now, total effect. Know the original 1-to-1 position on the 10-point spread, debit of 5, max potential profit of 5, 100% potential return. The new position of just moving up the long leg from 290 to 295, and I kept the 300 sold option in place, we lower the debit to 115. The new maximum profit, though, is only 385 because I'm in only a 5-point spread. The most I can get back if Microsoft is above 300 on October 1st expiration is 5 points off of 115. Now, this is still essentially a 335% return. I was able to lower the cost basis dramatically. I lowered the maximum profit, but percentage-wise, I'm much higher. So review, rolling up just the short, we increased the debit, risk, or exposure, however you want to call it. In our example, it moved from 5 to 770. We bought to close the 300, rolled it to the same expiration to the 305. We increased our debit by 270. The monetary profit almost increased by the same amount. It moved up from $5 to $730. However, there's a slightly lower percentage return, 100% versus 94.8% or 95%, we might as well just call it. And so about the same, but it depends on the fill prices. Why would I do this, just the short? It's further out of the money. We're rolling up to a higher strike. We're going to have a lower probability above compared to where we would if we just left the 300. You would only do this if you're really bullish on the stock going forward and you're comfortable with, you're comfortable with the new additional at risk. Okay, this is a bullish, more speculative move, moving just the short. What about rolling up just the long? We're going to decrease the net debit or risk on our debit spread from 5 to 115. This also decreases the max monetary profit because we've lowered the difference in strike prices. Now, my percentage return increases. I'm getting more bang for the buck, but that's mostly because I was able to lower the debit a little bit more. It keeps the same probability above, respectively, of where I was with my original trade to where I am now, because I'm still in the same short 300 strike price. We reduced the risk or the exposure, the net debit, drastically by just moving up the long and pocketing some of the profit we earned on the long. This is a defensive move. It's done to reduce risk, but still potentially look for more upside if Microsoft continues up in price. One is more bullish move. One is more defensive to reduce the risk and exposure if you're expecting choppy and volatile markets going forward. Of course, if you were expecting choppy markets going forward, you probably just would liquidate the position, take the 45% profit, and then look for a new trade that you were more comfortable with. But we've got a third option here. That's really the third option is liquidate. That's the first option. So our third option, or the fourth, roll both legs to a new spread. Don't just roll one, just roll both. Liquidate the initial spread for that profit we saw of 225, 45% of the maximum profit we expected when this initial bull call debit was opened. Now that that's closed and I pocketed the 225, our stock is roughly now, of course, around, I mentioned we were up there to that price at about 300. So keeping the at or out of the money bull call debit spread structure, we opened the same 1st of October 295 call for $12 and sell to open the 305 at 590, same numbers we saw in our previous rolls, but now this is one 10-point total spread. My new net debit is 610, but if I factor in the 225 profit from the previous successful position, that drops down to 385 is my new debit on my 10-point spread. So now my max profit is 615 or 160%. On August 24th, when we were evaluating some of these adjustments, when the stock was, roughly at about 302.62, excuse me, the 305 1st of October call had a 44.7% probability above. The 300 was 55.7%. So here we're lowering our potential probability. We're able to lower the true net debit, factoring in the 225 profit from $5 to 385, and we're increasing the max profit from $5 up to 615 by moving both legs up further and pocketing that initial capital that we had on the position. So quick table comparison. The original trade, we had a net debit of $5, 10-point strike difference. So the max monetary return was $5 on a $5 investment, or a 100% return. The original probability above that strike price of 300, on August 17th, the 1st of October, was 38%. Sentiment, of course, was initially bullish. We expected the stock to move up, and it did. Now, let's get rewarded. Rolling the short leg, we increase the debit, the only one that increases the new net debit, technically, up to 770, but we now have a 15-point strike difference. So we're still close to that 1-to-1 ratio. We've got a 770 debit with a 730 maximum profit on the 1st of October if Microsoft is now above 305. About a 95% return, a little bit less than 1-to-1. At this point, we moved up to the 305. Our probability at this point is 44.7% that the stock will be above 305 for the max profit on October 1st. Again, this is more of a bullish and speculative adjustment, just rolling the short leg. You do increase the maximum payout, your return stays about the same, but you also increase the net debit and the risk on the position. There's a higher chance for monetary loss at this time. It's bullish and speculative to just roll the short leg, but it can be lucrative. Rolling up the long leg, selling to close our 290, moving it up to the 295, and keeping the 300 sold that we initially did, lowered the net debit down to 115. We pocketed some of that profit. We rewarded ourselves. We've got a lower exposure of 115, but we also have a lower strike difference of only 5 points. Now, that does decreased the monetary profit to 385, but the potential return shows up as 335. But remember, it's not as if we can double or triple the shares of this bull call debit spread. Because we pocketed the profit on these contracts, we can't double the contracts using current market prices and see the same 385 to 115. It would probably be reversed, maybe closer to 1-to-1. Now we have a 55.7% probability of it being above 300 because we kept the initial short call in place. And again, this is a neutral to defensive adjustment. I've lowered my exposure, lowered my risk in case the stock reverses, but I still gave my chance for some upside profit, but I did lower the max monetary profit. Rolling both, factoring in, of course, the 225 profit we took from liquidating our initial spread that's at 45% of the maximum profit, opening a new position for a debit at 610, but with a 225, our new 305, 295 has a net debit of only 385. Strike difference is still 10 points. Maximum profit is 615, or roughly 160%. It's 159.7%. 615 off of a 385 true investment. Same 44.7% probability the stock would be above 305. This is both bullish and speculative and defensive. We cut down the net debit based on the premium we took in, the profit we pocketed for ourselves by closing that initial position. So we did lower the initial net debit. We increased the monetary return from the original $5 to a max monetary return of $6.15. So we did both. It's a little speculative because we need the stock to be above 305. Just like rolling up the short leg is bullish and speculative, so is this. But at the same time, rolling the long leg and combining both is both bullish, speculative, and defensive as well. So those are some of just the basic ideas when you're in a profitable bull call debit spread. Is it best to roll the short leg? Is it best to roll the long leg? Is it best to roll both? Which one is the best? Well, that depends on your outlook, your personal risk tolerance, and your goals for this strategy. Rolling the short usually increases the cost, will put you further out of the money. It can be very rewarding, but it's also speculative. And it increases potential loss. Rolling up just the long will lower your cost and risk, but it'll also lower the monetary return, but your percentage return looks a little bit more juicy now because of the lower debit and the lower cost. Rolling both legs seems to be the best of both worlds, but it's not every situation. It's just in this example. We lowered the cost in our risk. We increased the monetary return and the percentage return. It is also a speculative motion because I need the stock to keep going up to go above 305 to realize all of that. But at the same time, it's defensive because I did manage to lower the cost basis from $5 down to $375, $385. Of course, you could always just liquidate now, enjoy the profit, take that off the table, and then use power options to find a new at or out of the money bull call debit spread that matches your criteria. So there's just some insight to you on managing a profitable bull call debit spread using the at or out of the money approach for the bull call debit spread. Some ideas we have. There are other things you could do, adding multi-leg strategies to make it very confusing, but these are just the simplest ones for Ravi. I'm in a position that's successful. I'm staring at it and saying, should I roll up the short? Should I just roll up the long? Should I move the whole spread or should I just liquidate? This presentation gives you a little better idea of what you'd expect in each one of those different scenarios.